teach you guys a little bit about 401k plans here. You can use this knowledge for whatever you'd like, but the purpose of this video is to help people studying for their life insurance pre-licensing exam so that they can get their license and pass it on their first time through. But whatever, maybe you're just learning about 401ks on your own. I'm going to teach you a little bit about them here. So a 401k is essentially a program that allows employees to reduce their salary by deferring some until retirement. Okay, so what they do is they lower the amount of money that they're making. They say, hey, I'm going to take some of this at retirement instead. And we have Leia here, my little office dog. Say hello, who's going to help us study. So the money is then invested for gains. So whatever they defer from their salary is invested in gains, because the employer is going to match some of that money that the employee says, I'm going to push off until retirement, technically saving that money until retirement. That's why it's a retirement savings account. So the employer can match the contribution of the employee dollar for dollar or on a percentage basis. So they say, we're going to match the whole thing, or we're going to match up to a certain percent of your annual income or annual salary, whatever, or a percentage you put in, like whatever they want to match it on. So it's usually like a dollar amount or like how much based on how much they make. So the participants can receive the money that's given to them through income, or have money contributed to it's called a cash or deferred arrangement plan. So essentially that match is saying, hey, this is extra income that we're gonna have for you later on when you retire. So contributions from the plan into the plan are excluded from the employee's income. All right. And participants over 50 can make additional catch-up contributions up to a limit each year if they missed contributions when they were younger. So it means like up to a specified amount. So it means, hey, if you're contributing to a 401k plan and you're over 50 and you're maxing out your contribution now, but you didn't max out your contribution when you were younger, then you can still do that. Now in 2022, I'm going to check the 401k max contribution in 2022. It is $20,500. So in 2023, it's going to be $22,500 is the max that someone can have contributed to their 401k. So 401k is a little bit bigger than typical IRA, individual retirement account, or Roth IRA contributions. A SEP IRA is still biggest, but that's not for an employee. That's not really like the same thing. Because a 401k is for like large companies that have employees, and the employer is going to contribute to what the employee puts in. So plans typically in a 401k, if you take withdrawals before age 59 and a half, typically you're going to pay a penalty on them. There are certain like hardship withdrawals that the IRS will give you a break on, but it's really, really hard to get that. So for instance, like if sometimes very, very rarely can you get a hardship withdrawal for educational purposes. If medical expenses are greater than 7.5% of the employee's adjusted gross income, this is for 2022, then they can take hardship withdrawals from that account to help pay for medical expenses. Or there's without a penalty, because if you take money out of a qualified plan before like a 401k before age 59 and a half, then you're going to pay a 10% tax penalty to the IRS on top of whatever local or federal income tax that you're going to be paying. And also, there's no penalty if you're providing funds to a divorced spouse. So like husband and wife get divorced, and say the wife makes a lot more money than the husband, she can take money out and give it to the husband without paying a penalty on that money. If you leave one employer, what you do is you take your 401k and you roll it over into that new company's 401k, so that you don't pay any penalties on it, and you can get it invested in the new accounts in that company, their new mutual funds or whatever you're investing it in. So that's pretty much how it works for a 401k. It's a retirement account that has a little bit higher of a threshold for contributions, and essentially what the IRS is saying, hey, you can contribute to this and then get it later in retirement as income, and you can put it in here and earn interest on it and earn gains on it. It sounds like a really good idea, but to me, I really just think it's a better deal for Wall Street, because they get to take your money and make money with your money for years, decades, before you get to enjoy it in retirement. So they're making a lot more money out of your money than you're getting back. Whatever. We can get into the nitty gritty of it. That's just my personal opinion on it. I would rather invest in other things, but hey, there are plenty of people who retire well and have their retirement accounts in their 401ks, and they're stacking them up. So this is a way to contribute and lower your taxable income for that year. If you have any questions on this, just reach out to me at 774-606-6847. I hope you enjoyed this video, and I hope you either learned a little bit more about 401ks here, or I hope it helps you pass your life insurance pre-licensing exam. Thank you.